Hello everyone, Brent Kehrwecker here. Carey Cooley's out on vacation today. Thanks for spending a few minutes with me. We're here to share a quick update on the markets through July 31st, and more importantly, explain how the new tax bill just passed by Congress may impact your financial plan, especially if you're retired or nearing retirement. Let's begin with market performance from January 1st through July 31st, reflecting total returns with dividend reinvestment. The S&P 500 up 8.7%, the NASDAQ up 10.2%, the Dow Jones up 4.6%, gold up 26.5%, and the Bloomberg US Aggregate Bond Index up 3.8%. These gains reflect a strong rebound from earlier year volatility. Now to the big headline. On July 3, Congress passed a sweeping new tax bill. It makes permanent many parts of the 2017 Tax Cuts and Jobs Act, while introducing several new deductions and credits. Here's a snapshot of some of the items that are changing. Tax brackets and the doubled standard deduction are now permanent. The SALT deduction cap increases from $10,000 to $40,000 through year 2029. New temporary deductions for tips and overtime pay and expanded child and dependent tax credits are now available. A new above-the-line charitable deduction allows taxpayers who take the standard deduction to deduct up to $600 as a single or $1,200 as a joint filer in qualified charitable contributions. A major update to the gift and estate tax starting in 2026. The lifetime exemption increases to $15 million per person, permanently indexed to inflation. And this is exciting. Are you having a newborn? A new $1,000 Trump account will be created for every U.S. child born between 2025 and 2028, funded by the federal government to encourage early investing. The account grows tax deferred and can be used beginning at age 18 for education, housing, or other qualified expenses. So what does this mean if you're retired or collecting Social Security? First, I'm sorry to say there's no changes to the way Social Security benefits are taxed, but the bill does add a new $6,000 deduction for seniors age 65 and older, with income under $75,000 for singles or $150,000 for married couples. This applies whether you itemized or take the standard deduction and can reduce taxable income from retirement withdrawals or other sources. The permanent standard deduction and tax bracket extensions help preserve favorable thresholds for many retirees. In short, while Social Security itself wasn't directly impacted, these tax changes could directly reduce the amount of taxes you pay on retirement income. Before we wrap up, let's highlight some recent economic policy updates. Recently, the administration announced a new round of tariffs on many nations, effective early August, which were a continuation of April's trade actions. These are expected to increase corporate input cost and contribute modestly to inflation. And at its July meeting, the Federal Reserve chose to leave rates unchanged. Two governors dissented in favor of an immediate cut, making the first split since 1993. While no cut has been scheduled yet, markets now forecast up to 2 interest rate reductions in 2025, possibly starting as soon as September, though Fed Chair Powell emphasized that decisions remain data-dependent given risk from tariff-driven inflation. If you'd like to discuss any of these topics further, let's chat. We're here to help you adapt your financial plan in today's evolving policy environment. Hey, thank you for watching. Please like this video, subscribe to our YouTube channel, and follow us on Facebook for continuous updates.